Good afternoon and welcome to Unfiltered Finance. I'm your host, Ron Geffner. For people who don't know me, I'm a former SEC enforcement attorney. I'm a founding partner of the law firm Sadis and Goldberg, and I oversee the financial services group. At Sadis, we've organized and represented over 1,000 hedge funds, venture capital funds, private equity funds, and real estate funds. I've been active in the investment management ecosystem for over 30 years. I know how the financial system actually works, and it's about time you get to know how it works too. So today I'd like to introduce Duke Kim, who's with Securitize. We met recently, and the subject matter today is going to be tokenization. So we're going to explain what tokenization is, how it might affect you today, how it might affect you in the future, and other things that are worthwhile learning from Duke. So Duke, welcome to Unfiltered Finance.
Thank you so much for having me today, Ron. Just for, brief background on myself and as well as the company that I represent. So again, my name is Duke Kim. I am the Director of Institutional Solutions at Securitize, which is really a fancy title for driving the platform sales and conversations around RWA tokenization. For background there, Securitize is the world's leader in tokenizing real-world assets with about $4 billion in A brought on-chain as of the end of last year. We work with issuers such as BlackRock, KKR, Apollo, Van Eck, Hamilton Lane, and any number of what I consider household institutional names, and really working with them to bring the right products on-chain in today's market environment.
Well, I'm very excited to have you on today as a guest. So let's talk about what is tokenization in as basic of a way as you can explain it to somebody who has never heard the term before.
Sure. So, and that's really actually the best way to start from it is let's take all the jargon out of it. You can remove almost all of it and really think about digitization, right, which has been a trend over 20 or 30 years in capital markets and just the general retail environment. So in this world of tokenization for real world assets, specifically referring to private fund shares or securities more broadly, we take a traditional existing security that operates in a paper traditional or TradFi world and make a digital asset security. So all the same rules, responsibilities, rights, restrictions that existing traditional security would be beholden to is also then transferred or built into the code when we make a digital asset security or a token. So we work with great asset managers. We figure out what specific product, what specific fund, or it could be public equity, what they want to bring on chain, and we simply make that a digital version of that. But from we'll call it a securities perspective, it follows all the same rules and regulations that security would be beholden to. And that's actually really where we start the conversation and oftentimes where we end the conversation, because managers think that bringing something on chain can do something more magical or outside of the rules of law. And we try very, very hard to disabuse managers of that perspective as well as investors.
So what are some of the restrictions that you're referring to that a security would have that are going to follow along in connection with the tokenization? Give us some examples.
Sure. Great question. And so the first one that comes to mind is a manager that comes to us, and they may or may not be experienced, we'll call it, but they are hearing a lot about tokenization. And then if you tokenize a thing, it'll become more valuable because it's on chain. And we simply say, all of the traditional workflows that exist in traditional finance will be brought on.
By the way, I explained TradeFi, so you can use that word again. Yeah.
Yeah, of course. Well, I actually go, when I'm feeling feisty, I'll call it legacy finance, really.
Okay.
So, but this is really modernization of pipes and plumbing, right? We're not doing anything new. We're just making it more effective. So back to your question, managers will come to us, particularly would-be managers, and say, hey, we want to bring a thing on chain, and I want to get it listed on Coinbase. I want to get it listed on NYSE. I want to have it trade on these decentralized exchanges or these DEXs, right? Which is really just a website front end to a smart contract, which is really just a blockchain code. And we say, well, if we're about to take a security and bring that on chain, that security couldn't trade on. So we simply say, hey, it's a security through and through. Now, the first two words are digital asset security, but the last word is really the only thing that matters. It's still a security. Once they get that through their heads, then they realize, oh, great. Well, maybe my second question then is Duke, I want to bring a thing on chain because tokenization is all the rage, right? People like Ron Geffner are talking about it. Guys like Duke are talking about it. BlackRock's in on this game. I have an idea, and if I bring it on chain, I can get that idea funded. I can raise a lot of money. And so my first very blunt question to them is, have you tried raising money through traditional channels, right? Just regular people that aren't on crypto, that aren't on a blockchain. Do they think your idea is good? And have they already opened up their wallets for you? And if the answer is no, which often it is, then I'll say you have no further shot on chain, like in the crypto world. And I was thinking about it this morning, actually, why there is such a big disconnect from a manager that is looking to raise capital and why they think crypto, DeFi, these blockchain cowboys, why that is so attractive to them. And I've realized it's the degeneracy on chain that is very attractive to these people that have what I call the 1% portfolio allocation idea, right? So I have people that come to Securitize, come into my inbox, come into my DMs via whatever channel and say, I have this great idea. I need you to raise money for me. Or if I tokenize it, that is the way to raise money. And it's taken me a long time to figure out why that is. And I think it's because they see people that, if Ron, we've probably heard of meme coins or shit coins, right? There are plenty of people on Twitter that will say, oh, I bought this thing yesterday.
Like Doge as a meme coin.
Doge started in the we'll call it in the basement of Reddit, and someone said, wouldn't it be funny if I liked someone's comment and instead of tipping them 2 pennies, I tipped them 20 million of a thing. And so that's how Doge was actually created, was just, isn't it funny if instead of saying, yeah, it's 2 cents for you, 5 cents for that very insightful comment about my dog allergies or how I can fix my car, I think that's just funny for some reason. Doge was born. That's how it started. They thought it was funny because it was just a much bigger number.
Yes.
Has no meaning. But the people that I'll use invested here very loosely, but gambled on Dogecoin or any of these other things that we've created, or at a market cap, or simply I bought it at a penny and it ran up to $10 a share or a token, and they become instant, overnight, over hour millionaires. And I realized those people are not accredited investors. They're not ever going to go through a process to be verified, KYC'd, go through an AML check, show their driver's license and be verified as a potential investor for security offering. That population is completely different. I really work with anyone that comes into the funnel and say, hey, we make a security. So the thing that you're going to start with is a security. And if you had no traction raising capital in while touching grass in your outside world, you're not going to raise capital with your computer.
So AML, for those who are not aware, stands for anti-money laundering. When you're making reference to manager, you're, in my mind, somebody who's managing other assets, probably through a fund like a hedge fund, private equity fund, venture capital funds. And rather than, in their mind, complete subscription documents, wire money, go through all the steps and machinations to get the money transferred over to the asset manager's fund, they assume that due to the hype of crypto, that this is a next stage of that hype by putting their offering in a digitized manner on chain, that random people who they don't know are going to invest. For the most part, those that are registered and those that are private placements or not registered and operating pursuant to Regulation D. And for private securities, there are rules one needs to follow to determine the qualification of the investor in an effort to be paternalistic and protect the marketplace from bad people who are taking advantage of retail.
So when people look to the amount of money that can be made with decentralized finance, again, all of the traditional Wall Street workflows of buying and selling securities, raising capital. Like you said, there are rules in place for a reason to protect investors, to make sure that there is transparency in reporting, to make sure that the person you've entrusted money with is doing the thing that they said they would actually be doing. So if you think of Ponzi schemes, right, they're Ponzi schemes exist in crypto, just like they exist in the traditional finance world. Again, that's also then why platforms like ours seek to make sure the things that we create and the people that we work with are following those same rules. And the investors that come through, that same concept of checking who you are, making sure where your money came from, that it did not come from illicit activity. If you think of North Korean hackers that are all over the news for what they call draining wallets, or basically, getting into your computer and taking all of the tokens or the things that are on your crypto wallet on your computer or your phone, want to make sure that those funds aren't used to invest in legitimate businesses or legitimate securities offerings. And I can't emphasize this enough, which is what I'm doing, I guess, on this conversation, is really making sure that those same rules, regulations, verifications of the investor and the manager, those are occurring in an on-chain world.
So when I always imagine somebody in the audience listening, especially with some of our guests, I imagine some of them saying, it's like when I was in high school and people were in college. And I'm like, how do they get to college? It seems like such a complex process. Like it was a scary concept, even though I knew nothing about it. And then you go through and you're like, yeah, this is pretty, you have some hoops to jump through, but fundamentally there's a forged path. So how did you get to sit in the seat you're sitting in? Meaning, what were you doing before you got involved in any, whether it's crypto, tokenization, or anything else? What was your former life like? And what was the light bulb that went off in your head that eventually got you to Securitize?
So we'll call it, Bitcoin was invented or released during the global financial crisis.
In 2008.
2008. At that time, I had finally clawed my way onto Wall Street. I'm a liberal arts major, a kid from a small town just outside of Dallas. My dad is not anybody. My mom is not anybody. Somehow I hustled my way onto Wall Street, onto a trading desk, actually. And that story involves me making my way to Atlantic City in the middle of the night to meet with the managing director that I wanted to work for. He had a bet, basically, that I wouldn't make it, that I would not find my way to get to Atlantic City with no car as a summer intern on the trading desk at Bank of America. So the end of that summer, I got the job offer. I became a trader. Then the global financial crisis hit. And somehow I survived multiple rounds of layoffs. Bitcoin was created. I had no idea about it. Fast forward a little bit. I'm on Reddit in the middle of the night reading about, somehow I fall down this rabbit hole and I start reading about Bitcoin. And the way I was reading about it, or the way it was discovered, was, oh, you can buy drugs in the mail.
Yeah, the Silk Road.
So
what time in history is this, so we can put this in perspective?
This was probably 2011, 2012.
Okay, and still early.
Still very early.
Not completely foreign.
Right. And so we'll call it this, and I'm a 80s baby, grew up dial-up internet in the 90s. And so there's this cypherpunk ethos of people that can just use computers to do really cool things, right? Where most people were still figuring out if they believed in the internet, there were people that were really forging ahead and thinking, hey, this is where we are today. But if we squint our eyes, we can see this future in which, things can occur faster with less intermediaries, people in between, less middlemen. And Bitcoin started, or one of the reasons it started, as this, at the time, a medium of exchange, right? That things were a couple of cents each, maybe $1. It seemed a little bit more accessible than it is now from a price point perspective, we'll call it. People look at Bitcoin saying, hey, it's $70,000. I'll never be able to afford it. Not realizing you can buy a fraction of one, right? You can buy $10 worth of Bitcoin. So I'm on Reddit in the middle of the night and I start reading about Bitcoin, and I start reading about these people that were using, going into the Silk Road, which is kind of the underbelly of the internet as we know it from a website perspective and things of that nature. And I thought to myself, this is bunk. This is very difficult because I can just text my guy in New York who shows up on a bicycle with a backpack and says, here's $50 worth of whatever you'd like to purchase.
Sure.
So I said, hey, that's a lot of work for something. I don't need to worry about this just yet. Fast forward a little bit, Bitcoin's still around. global financial crisis. We're all reeling from it, and people are starting to buy into the philosophy of what Bitcoin stands for in terms of this independent asset, this hardened asset, this asset that cannot be inflated away by central banks or by the money printers, right? They say, hey, in the hard code, there will be 21 million of this thing, no more. So it is really a better version of gold, was one of the first arguments, right? We actually don't know how much gold is really underneath the ground. Here's a thing that we can create with our computers, power to the people, and the value of that thing is going to be controlled by us rather than by some masked cabal, central banks, and things of that nature. So around 2018, post my Wall Street career, I was at Bloomberg. And I remember talking to a gentleman, one of my first friends that I met there, saying, hey, this is a really great place for you to work, Duke. You'll never get fired. And I immediately thought, I don't want to die here. I still have more to do. I still have more to learn. I want to do something else at some point. So for 2 years, fully loved the Bloomberg atmosphere, the culture, loved getting to still hang out with my friends from Wall Street Times, right? During the early 2018 timeframe, my wife had actually come to me and said, hey, I work in an office space with crypto exchange, with this other group. They are selling accounting software. And that company, though, had survived a year. And they needed someone to actually be an account manager to say, hey, Ron, you've been paying us for a year. Now we need to talk about renewing your subscription to our software as a service, our SaaS products. So I joined a company called Libra in the summer of 2018, and it was started as a retail tax calculator for Bitcoin solely, and it evolved over the last several years during that time period into being a subledger, or really that data aggregation for people doing stuff with crypto. You're buying, you're selling, you're holding, and all of the traditional software that existed couldn't handle Bitcoin. They couldn't handle the decimals. They couldn't handle any of the new crypto assets that were being invented or created or launched. Didn't know what to do. And so everyone that was trying to be institutional at the time was really relying upon spreadsheets. And so I came in as we'll call it the director of account management, understanding how fund administrators, accountants, auditors, people that were dealing with managers, this that we talked about a few minutes ago, that were starting crypto-focused hedge funds, right? Ron and Duke's crypto hedge fund trading Bitcoin and Ethereum and whatever other assets. The traditional providers didn't know what the hell they were doing, what the actual manager was doing, much less what the manager, the auditor themselves were doing. And then the software that they traditionally relied upon to service a hedge fund that just traded equity or fixed income products, they had no software. We had that software. And so that's how I started my career. And since then, I continued to leverage my capital markets, my Wall Street background, my Bloomberg training, how to sell software, how to be a troubleshooter of that software, and really understanding what clients were doing with the things that we were selling. Fast forward quite a bit, I ended up at Securitize about 15 months ago now.
What are some of your learning lessons in connection with cryptocurrencies, digital assets, that somebody listening might really benefit from your life experience?
The big one from an investor's perspective, I think that the biggest thing is that incentives are the only thing that matter. So if people that are really outside the world of crypto, right, and they've only heard it mentioned briefly on CNBC or they see it in the newspaper, their first thought, and we've seen this with the regulatory stance here in the US as well as globally, the first thing they think of is scams or Ponzi schemes or just really bad actors, right? And so they only think of these horrible use cases for what I think is truly the next asset class in capital markets world. But also just because of the nature of this beast and really the nature of the internet, right? It's, you can be anonymous, you can send more messages, over email than you could by stamping a letter. And if I wanted to write mean letters to you, Ron, and physically, right, I would have to handwrite each note or type each note, stamp an envelope, put it in the mail. Takes a long time to send you 10 messages saying you suck, right? I can use a computer, email software, some sort of automation, and spam your inbox a billion times over, right? The incentives to be a bad person can sometimes also be amplified or accelerated in crypto. And again, you think about the fact that some people could make money, take a $10 lowercase I investment or a bet on a thing that just got invented and turn that into $1 million, right? So it really hammered into me that incentives are the only thing that matter in this world, but also just in an investing community. The second piece alongside that is risk management. So investors walking in have to be worried about, who am I trusting with my money, with my crypto assets, my tokens, right? Who is Ron Geffner, right? Can I trust him to do a thing with this thing? I believe that his incentives are aligned with mine. He's made me a lot of money. Now it's about risk management. And this is just like the same thing that I would tell you if you were an early investor in Tesla stock or Nvidia shares, right? It's, hey, you bought the thing at $12 and it trades at 250. Shouldn't you take a little bit of chips off the table, right? That's what I would say to a guy invested in equity. So in crypto, if you made money on a thing, think about how you exit and crystallize or actually sell those assets and capture that gain, right? That's trading 101, investing 101, risk management 101, right? You get on a hot streak at a table, you run up your $200 stake to $2,000 or God bless you, $20,000. You should know when to walk away. And we've seen it over and over again and this would be about my third cycle, from a crypto perspective in terms of Bitcoin running up to all-time highs, things of that nature. It's this constant remembering and reinforcement that greed is not your friend, but your paper wealth is nothing until you can actually take that money out.
Hence the saying, pigs get slaughtered.
Yeah, pigs absolutely get slaughtered. So it's really about knowing who you're dealing with, understanding where the incentives are, and then understanding when you should try to get out of a thing. And hopefully it's a winning trade, right? Hopefully you make some money with it.
But that applies to all investments across the board. Anything specific, in addition to what you said earlier, tied to tokenization or digital assets? Because, and the reason I'm bringing that up is there's clearly a disconnect between people who think tokenization means that you can sell the asset to a bunch of other people at almost any valuation. And just so the audience understands, because you were talking about probably two different alternatives. One where you have somebody who's managing a private fund looking to attract investors by tokenizing the interests in their fund. But there's also people that are tokenizing real estate assets. Or you just mentioned like that, yeah, I cannot afford a token of Bitcoin at 70,000, but if I knew that there was alternatives of putting in $10 or $100, I'm receiving a portion of a token. Same concept on a macro level. What other are you seeing any other mistakes or people that are trying to do this legally? Right, I'm carving out the snake oil salespeople, or the fraudsters, or the Ponzi schemes.
Yeah, I think I still actually stand by it that there's really nothing new under the sun to learn. But I think the lesson is that there is actually nothing new under the sun to learn, right? And to be aware of. So in your first example of a manager, when you think of the modern portfolio, the optimal portfolio, so I call up my wealth manager at Fidelity and he says, well, Duke, you're a man of a certain age. Based on your age profile, I would recommend a 60-40 portfolio, 60% equity, 40% fixed income. As you get older, we'll slide that around a little bit.
Yeah, fewer equity is more fixed income.
Yeah,
it's an age-based allocation model.
Yep,
for those
exactly.
that are not following.
And then at some point you get to a certain income generation. So, I get promoted in my job and I'm making a little bit more money. Now that manager comes to me and says, hey, Duke, you should think of your allocation now from not just pure equity and fixed income products, but maybe some alternative products. Get into a hedge fund, get into a venture fund, invest in your buddy's ice cream store. And that was actually my first investment. With my brother, we opened a gelato store in Korea sometime post my Wall Street career. And that was the fastest, I think probably the fastest I've lost, 5 figures of capital that I've ever experienced before. But that manager will say, hey, you should invest in these alternative products, right? And that's typically, and Ron, you know better than all your listeners here, right? That's generally should be a small portion of your overall assets and your wealth. All of the people that are trying to, or that see tokenization as, they see tokenization as the solution to getting that tiny sliver of portfolio allocation. They think that tokenization is a distribution mechanism. They hear everyone screaming about it on YouTube and Twitter and X and LinkedIn. I have this idea. I haven't been able to raise money by networking with doctors and dentists and lawyers and going to my country club and all the traditional ways that managers raise capital. And they hear about all these people that are making money on silly animal coins and NFTs and trading pictures online. And they say, it seems like there's this huge ball of money that is swirling around on the blockchain. And if they would just hear my idea, I'm going to get a piece of that.
Yeah, so the presumption is tokenization is a path to some nirvana where people are dying of thirst and hungry for any morsel of food. So whatever you have, they're buying.
100%,
yes.
Right?
And I agree with you. And it's been very confusing for us over the last year or two when we meet managers who are seeking to distribute their offering through tokenization. And in their mind, there seems to be unlimited demands.
That's exactly right.
And then at some point, reality hits. So let's fast forward, and this is to the unknown. If tokenization leads to secondary markets, which means there is an organized platform where people come to invest in a broad range of assets that theoretically are more efficient because of tokenization. There's less paper, so you should be able to document, execute things in far shorter time frame than it would be in the traditional sense, even better than DocuSign. Where is the best case scenario you see this going? Let's go with that. Where's the best case scenario?
All right, this gets really exciting, Ron.
This is Star Trek stuff, baby.
So you've taken real care to slow me down on tokenization, helping your audience understand what it really means, right? Taking a securities offering, bringing a thing on chain. And that narrative, so in the early 2020s, I guess is the right way to put it, right? Any number of real estate groups, any number of fintech startups were trying to tokenize real estate and tokenize things, and they all failed spectacularly. Fast forward a little bit, over the last couple of years, companies like ours, some of our better competitors, right, have really started gaining traction and building true tokenized products with mainstream appeal and distribution, right? But these products are issued by what I call household asset managers like a BlackRock or a VanEck or Apollo. And they bring their products, one or two of their offerings or strategies, people like us bring them on chain. The new narrative that had come out really, we'll call it the middle of last year, end of last year, is this vault concept. And a vault is just like you think of a traditional vault. It's where you entrust assets into, right? But here it's fully on chain. So in a technical term here, a vault is a smart contract hedge fund, right? You entrust assets into a bit of computer code. So you have shares of a company, you have some fixed income products, some treasuries, what have you. This vault will, it's not a fund, it's not a private fund or registered fund, but it's just code that says, if you give me X and any number of X units, I will go do Y activity to make more money with that thing, right? So let's keep it really simple and say, if I give this smart contract $1,000 of stable coins or digital dollars, I'm going to find the right strategy to make, take that $1,000 of a stable coin to $1,100 in a specific time frame using this specific strategy. That's here. I think it's here to stay. We see traditional managers, some we'll call it crypto native managers, really diving into that type of product, right? And then people like yourself, Ron, lawyers, securities experts, et cetera, are really trying to get their heads wrapped around that to say, what are the rules? How should
But
it be
that's
regulated?
by the way, that's the blockchain, not
That's
necessarily digital currency.
correct. So they're trying to
And real
understand.
quick, sorry,
Yep.
I hate to, because we're going to lose people. How would you describe what blockchain is, and differentiating it from some concept of token?
So a blockchain is really a new way to store data, right? So oftentimes people will dismiss blockchains because, hey, we've already got SQL databases, we already have Oracle running around and powering all these computers and file transfers and data movement across the internet. What good is a blockchain? Couple of different things, really high level, right? Because it's a shared ledger, everyone has the same. We can all agree that Ron owns two things, Duke owns one. We're all in agreement with that thing. It can be really fast. It can be what's called immutable, which means it can't be changed by any one person. So if you think about how much trust you put in your traditional bank, whether that be Wells Fargo, Chase Bank, whoever else, on some level, you make the wrong person angry, they can go into the computer system and say, Ron has this much money, 2 button clicks on the keyboard. Surprise, no, you don't. Whereas a blockchain, because everyone has to be in agreement, everyone has done the mathematical calculation to come to that same sum total in everyone's account, right? That can't be changed without everyone agreeing that should be changed. So there are use cases for it beyond what a traditional database can support.
Going back to the vault.
Going back to the vault now you have this smart contract, which is really just computer code or blockchain code, right? It acts like a hedge fund, or it can act like a hedge fund, right? So you are entrusting it with your things, your money, or your tokenized fund shares, and it will go do a thing. That was the narrative that had rapidly emerged at the end of last year. If I think forward, 2 years, 3 years, you will now have these vaults that are optimizing all of your audience's assets because all the assets have been tokenized, right? So your home mortgage, your bank account, your cars, your retirement accounts. And now you have these vaults, right? These things that are running on a blockchain that act or look like some sort of hedge fund or manager to optimize all of your capital and all of your wealth. Case in point, I'm saving up to buy a new house, and let's call the house $1 million, and I need $200,000 as my down payment. So I am in advance because I'm about to sign my paperwork on April 1st. So sometime around mid-March, I'm going to call up my brokerage, my traditional brokerage at Fidelity or whoever else, and say, hey, I need to liquidate some of my investments in NVIDIA and Tesla. I'm going to sit on cash for a little bit. I need to borrow some money from my friend Ron. I need a little bit of cash from my parents. Well, all the things. I'm going to, take a home equity loan on my existing, all the things that I'm doing. And now I'm sitting on something like $200,000 in cash for 15 days or 15 minutes. If that capital can be entrusted into a vault for the time period that I need it to, and I say, hey, I need to make sure that money is available to me when I go to the bank to sign my paperwork. Do all the stuff you're supposed to, make as much money as you can within X bounds of risk.
Whatever within that time frame you've got in cash.
Yeah. Exactly. So now I can truly optimize all of my assets, all of my holdings to do the things that I really want. Buy a house on March 1st, save up for vacation in September, pay for my kids' college tuition, 15 years out from now, right? And the thing that I actually forgot is the agents, right? So, and I don't generally like to blur crypto and AI, but AI is obviously a brand new narrative that is really taking shape, and a lot of people started hearing about agents that are acting in AI, which are really autonomous or self-acting computer code, right? It's simply saying, hey, I needed to do a thing. Right. So now you have these agents that may understand Duke is trying to save money for a vacation in 6 months, trying to save for his daughter's college education in 15 years. How do I optimize everything? If everything's a token and all my wealth is all of my assets, all my holdings are represented digitally on a blockchain, I can entrust that with an agent and a vault to do all the things that I need to do within my defined risk parameters and control, and what do I invest in and all that stuff, so that I have money to do stuff that I really want to do and enjoy.
But how does that how do we differentiate that from, I can go on, one of my asset managers is AllianceBernstein. I can click on it, see what's in there. I can email instructions. I can see them transfer the assets. I can go on a Schwab on my phone, look at my accounts, or Citigroup. What more do I as a consumer get by the blockchain versus my current digital access through the internet? That's something I'm still missing.
Yep. So the first one is speed, right? So you jump on LinkedIn, you jump on Twitter, there is some fintech guy, some crypto gal that is saying, oh, I tried to wire money yesterday and it took me 4 hours inside of the bank, and they had all these questions, and then the money transferred. It leaves my account today, March 10th. It doesn't get to Ron's account until March 13th. Well, who the hell had my money for 3 days, and who actually earned interest on that money for 3 days? It wasn't
so you're
me.
saying the lag time. So it reduces the lag time.
It reduces the lag time. And then if you think of this younger generation that's, well behind us by a number of decades, right? There's also this lack of trust in the institution, right? So you and I have a guy that we call, right? Or a woman that we call that manages our stuff. Younger generations, they don't want someone else to manage their stuff. They don't want an institution that they have to trust right now, because again, if I broadly wave my hands in the air, right, there's this all-time low trust in institutions, right? Those people, those rules, those things weren't built with me in mind. And
that, as you like to use the word narrative, makes sense post the financial crisis in 2008, when all of a sudden there was a concern, like Lehman goes under, Bear Stearns goes under. Question was, who was next? So disintermediating our assets from institutions, on some level, I get it. But conversely, when some of the banks that had crypto exposure, like Signature, started to have failings occur, runs on the bank, what we saw was there was a connectivity between every bank. Everybody has exposure through everybody else, right? All ships rise together and all ships fall together. So if we follow that thesis out and we believe in decentralization, I would question whether decentralization technically really true, even if it's on the blockchain, but it's going to affect other companies, we could have mass failure regardless.
I would definitely challenge that, right? So if Bitcoin, or if one of the value propositions or the philosophies of early Bitcoin people, and even now, right, even if you jump in at 70,000, is this concept of self-sovereignty, right? Because when the financial crisis occurred, young folks, people that are outside of Wall Street were like, great, a bunch of rich people lost all their money. Oh, well, that bank actually controlled my 401k, right? Or my assets were held there.
Yeah, and they realized everything's really unrelated.
And then they realized, oh, I got banged up here, or this company that I bought into is actually really invested in this other company. It's
contagion.
And it's contagion. And the impact of contagion is all that stuff is outside of my control. So when you have full, as much as decentralization as possible here within the rules of regulations and investor protection, you have at least the sense, and I would argue the actual much more control of your destiny, right? So the Bitcoiners that fled, India, and they memorized the passwords basically to their crypto wallets, right? They didn't have to trust a central bank. They didn't have to trust that the fiat currency, the paper money in their wallet or their purse, was actually worth that. They didn't have to worry about or trust anything else. All they had to trust was their memory. And these are real stories, right? From my nonprofit time, I've worked with women that have crossed multiple borders with their siblings. We lost our home, we lost our family, we lost all of our wealth. But I remembered 12 words in my head, and as soon as I can get back down to a computer, type them back into a crypto wallet, and boom, I have my Bitcoin, right? And I have access to it, and I can spend it, and it has value. So you fast forward to where we are now, right? And where I think we're about to go with AI agents and crypto vaults and digital assets, right? gives a lot more control to the user because, and again, if you think about this was like an early 2000s movie, Enemy of the State, right? And even the Will Smith movie, I think it was not iRobot. I always blank on the name of it. People are worried about, actually, Mr. Robot. Sorry, that would be the good one here. The TV show Mr. Robot, right? These hackers get into the system and delete everyone's student loans, right? But what if those people got into your bank accounts and just deleted all the records at Chase Bank, right? Investors now, younger generations now, don't have that trust in the institution, and this does give them actual control, and I think it gives them a feeling of control as well because they can control the assets themselves. They can
you're
see
going
where
back
it
to
is.
blockchain being immutable, meaning you cannot
immutable.
change it, and it requires the involvement of more than one person across a blockchain to make those changes.
Yep. But the other side of that is also transparency. So when you think of contagion effects at the banking level that occurred, was that everyone had lent to each other, everyone had rehypothecated or lent out their borrowed assets to other people. But it's very murky, right? Even sometimes if you talk to the middle office teams at one bank versus another, they're like, well, it'll take us 24 hours, 48 hours to figure out ultimately who owns your mortgage, right? Because it's a shared, distributed ledger of that activity. Much easier to find to navigate that spider web and all that spaghetti and say, here's actually who owns your mortgage. Here's actually where, the dollars you've lent into this institution, who actually is holding it at the end of the day, right? It's faster, it's more transparent, and it does give trust to the institutions that should be trusted.
So one final question, because we're running out of time. Whose careers will benefit and whose careers will suffer if you're looking into the future due to tokenization?
Fantastic question. I don't know if there's an in order, but here's how it's just hitting my head.
Yeah, just share your thoughts.
So if you think about the efficiency piece of it, so folks that work inside of big banks and the operations in the middle and the back office, things are going to get faster. A lot of things are going to get more automated. Those jobs are going to get squeezed. But they were probably already worried about AI taking over anyways. So I think tokenization just speeds that narrative and that concept up a little faster. If you think about risk management or asset management, and I talk to a lot of financial advisors that say, how do I get involved in crypto? I want to reach this next generation of investors and people that will have wealth to manage. Younger generations don't want people like you and I talking to them about risk management from a asset selection perspective. They're worrying about estate, tax efficiency, things of that nature. Is going to be strained. But we were also already seeing that with robo-advisors over the last 5 or 6 years. So again, nothing super new, but it's just accelerating what's already, kind of what's already been going on, right? It's just, we're just rolling downhill a little bit faster here. Tokenization, again, blockchains, they're not necessarily always revolutionary. I think they're evolutionary in terms of, what they're actually doing, the impacts that are going to be felt. More broadly than even hedge fund managers, right? Because you're going to have AI bots, these vaults that can pick better assets, maybe, that can maybe time trades better for you, ins and outs to an opportunity they see in the market, just because they can, both see and also synthesize data faster than anybody else. So we're going to see that speed up occur for sure.
Yeah, and that I met with a client of ours a couple of weeks ago, and they manage, I think, about $11 billion. Their research departments are going to be affected and have been affected by AI. But where the value might be is the person with the contact with the clients. The relationship, even though you're saying the younger people don't necessarily want to have to trust somebody, I'm not sure I agree with that perspective. I think the human condition is we like to be part of a community. It provides us comfort, safety, and identification. But we certainly know this. Blockchain will definitely affect society, I imagine, for the better. Tokenization, early days, we'll see where it leads. So first, let me just thank you for your time today. Duke Kim from Securitize. I'm your host, Ron Geffner. And maybe we'll have you come back periodically to talk about new developments that you're seeing.
I would love it. Thank you so much for having me, Ron. Thanks for listening, everybody.
My pleasure. Thank you.